Welcome to a UI walkthrough for the Term Finance app. I'll guide you through how to use our interface to obtain fixed rate, fixed term loans via our weekly public auctions. Our auctions are announced up to a year in advance, allowing lenders and borrowers to review key information such as the auction open date, the term and maturity of the loans issued, the asset that the loans are issued in, and the collateral that borrowers are required to deposit to secure their loans. Our filter feature helps users to quickly locate auctions that meet their criteria, such as filtering for loans with a 4-week term. Once an auction opens, users can participate by submitting bids and offers to secure fixed-rate loans. All of our open auctions have their own dedicated page that contains the auction details, a form for lenders and borrowers to participate, and a table that displays the tenders submitted by the user for that particular auction. So here we're viewing an auction that offers 4-week USDC loans that are backed by ETH with a maturity date of June 12th. To reduce risk, term repos are over-collateralized loans and borrowers must adhere to the initial and maintenance collateral ratios. The initial collateral ratio represents the minimum amount of collateral required for a borrower to open a position, and the maintenance collateral ratio is the point at which a borrower's position would be liquidated. Auctions usually remain open for around 12 to 24 hours, giving lenders and borrowers the flexibility to submit tenders at any time during this period. Now let's delve into the simplicity of participating in the auction by submitting tenders to lend and borrow. Firstly, let's say you're looking to provide a USDC loan. You simply have to specify the amount that you would like to lend and the minimum interest rate that you need to receive in order to make the loan. You're able to create several offers of different sizes and rates and submit them at once to save on gas fees. So here you've stated that to supply 1 million, you need to receive interest of at least 3.5%. You'll supply an additional 2 million if you can receive 5% interest or more. Your offers add up, so if you place several offers that are at or below the market clearing rate, they'll be accepted and combined into a single loan at that rate. Upon submitting your offers, your loan assets, so in this case USDC, will be locked for the duration of the auction. You can edit or delete your offers at any time during the auction, and if you delete an offer, your loan assets will be immediately returned to your wallet. Now let's consider the opposite scenario, where you're interested in obtaining a USDC loan. It's a similar process. You indicate your desired loan amount, the maximum interest rate that you're willing to pay, and the collateral that you'll use to secure your loan. So in this auction, you're required to deposit collateral worth 150% of the loan amount as a minimum, but you can opt to deposit more to reduce the risk of your loan being liquidated. So here you've specified that you'd like to borrow 2 million if the interest payable is 3.5% or less, and additional 5 million at 2% or less. Bids also add up, meaning that all of your bids that are at or above the market clearing rate will be accepted and merged into one loan at that rate. Upon submitting your bids, your collateral will be locked for the duration of the auction. Again, you can edit or delete your bids during the auction and have your collateral returned to your wallet. After the auction closes, our smart contracts will determine the market clearing rate. Borrowers who bid at or above the market clearing rate will receive a loan at the market clearing rate. Lenders who offered to lend at or below the market clearing rate will make a loan at the same rate. All other bids and offers that didn't make it to the market clearing rate are said to be left on the table, and the associated funds will be immediately returned to the owners' wallets. Once the auction clears, successful borrowers will receive their loan amount minus a service fee, and lenders will receive term repo tokens, which are ERC20 tokens that are essentially receipt tokens that lenders can use to redeem their initial loan plus interest when the loan matures.